Okay, so again, good evening. Our topic for today is about describing investment data. So, of course, investment methods or investment are generally defined as transaction conducted with the intention of generating income or selling the underlying instrument for a higher price at a future point in time. So, what is investment? So, a financial investment is any asset or instrument purchased with the intention of selling said asset for a price higher than the purchase price at some future point in time for capital gains, no? Or with the hope that the asset will directly bring in income such as rental income or dividends. And this guide will review the three main investment methods for asset classes. So the exact criteria for a transaction to be considered an investment, however, is not so this concrete, no? From a broad perspective, there are many different categories of investment, especially in terms of accounting. Different transaction may be constituted as investment by different people. Let's say, for example, no, a lease transaction may be seen as an investment by some but not by others. So in a very broad definition, an investment can encapsulate any action or operations undertaken with the intention of generating some form of future income. As such, even the act of producing goods with the intention of reselling them in the future can be seen as an investment. Okay, so again, as I mentioned earlier, there are certain types of transactions that are easily seen as financial investment, and there are the focus of this discussion. No? So a simple way of classifying investment is to divide them into three categories or investment methods, which is debt investment, yung loans, equity investment, yun yung company ownership, and hybrid investment that is convertible securities, mezzanine capital, or preferred share. So to give us more details, I just want to play a video presentation wherein you could able to understand more with example. Please bear with this video because we have 7 continuous video not related to investment, because an investment is topic is very important, and we need to understand this one since you are took up office administration. Let's say, for example, you were possibly hired as the manager, so you need to understand on how your company invests, no, and how your company be able to, of course, to get an income, no, from their investment. Okay, so I just want to share my screen again. Okay, if you have some questions or clarification, or do you want to have something additional inputs, do not hesitate to post your question or chat through our chat box, no? Comments, additional inputs sa chat box lang po.
My name is Tim Davies and welcome to our FTS online class. So in the previous 2 readings, we covered a lot of fixed income definitions. Now we're going on to the valuation. And what we're going to see as we go through this is that we're going to be applying a lot of the concepts that we learned in quantitative methods. So I quite like this because it reinforces a lot of what we learned back there in quants, especially time value of money. The only thing that's not so great about this reading is that it's very long. So I guess we're going to have quite a few classes to get through this reading then. But anyway, we will get through it. So let's get started. Right. So the first thing we need to do is calculate a bond's price given a market discount rate. So the price of a bond is just like the price of anything. It's just the sum of the present values of the promised cash flows. So we're going to use the market discount rate to calculate the present values of these cash flows. And the market discount rate, what it is, it's the rate of return that's required by investors given the bond's risk. So the higher the risk of the bond, the higher the rate of return is that's going to be demanded by investors because to compensate them for the extra risk. But the lower the risk of the bond, then we're going to see the lower the rate is going to be that's going to be required by investors. So this is why it's called the required yield or the required rate of return or the yield to maturity. And as we're going to see as we go through this reading, that a yield to maturity, that is actually an internal rate of return. We're going to be doing it in this very class. So something to look forward to. But for now, let us try this example. So we've got Riverside Retail. They've issued a 3-year bond. So they're borrowing money. And they're paying, it is an annual coupon rate of 5%. I just want to stop there for a second, because this is, if they don't say anything else, we always assume that this coupon is fixed. So they're going to pay 5% coupon annually here over the 3 years. There's an annual coupon rate of 5%. And the market discount rate is 8%. So if we need to work out the price of the bond per 100 of par value, what do we need to do? We need to take here the future cash flows in all the numerators. So if the coupon is 5%, and we're looking at a par, the price of the bond per 100 of par, so 5% times 100 is $5. So the coupon is going to be $5 every year, year 1, year 2, and then year 3, we've got 105. Why? Because with a bond, we know that the Riverside Retail, they need to pay back the par on the maturity date in 3 years' time. So the final cash flow will be the par of 100 plus the final coupon of $5. Right, so now all we need to do is 3 separate little present value calculations. And then once we've done all those, we sum up the values, and this gives us the value of the bond. So what have we done over here? This $5, we expect that that's the first coupon end of year 1. So we discount it back 1 year at the required rate of return. So $5 in 1 year's time is worth $4.63 today. And we do the same with this one. We're getting this $5 in 2 years' time, end of year 2, discounted back 2 years. So it's worth $5.29 today. Then the final payment, the big one, the 105, we discount that back 3 years. So the 105 is worth $83 today. So this is the value of the bond today. So I just want to stop here for a second, because this is actually quite similar to how we looked at the value of a share or equity when we did the dividend discount model, except of course the difference was with shares, we had dividends here in the numerator, and also with shares, shares, there's no maturity date. So we had to estimate over here the term, we called it the terminal value at the end of the term, whatever term we were looking at. So there we were estimating what the selling price would be after 3 years or whatever. Now with a bond, we know with bonds, the issuer has got to pay back the money at the end of the term. So we've got more certainty here with this final cash flow in bonds compared to in shares. Right, but otherwise the principles, they remain the same. So if we now if this is on the exam, we're not going to do 3 different present value calculations. We're just going to plug the numbers into our calculator, and we can use the payment function. Why? Because the coupon, it's fixed. It pays 5% every year for 3 years. So that's like an annuity, like we did in quant. So we can use, so if we're the investor, we're going to get $5 a year every year for 3 years, and then the par is going to be the future value. They're the 100, because we're going to get that back at the end of the term. And then the discount rate they've given us is 8%. So this is now the value of the bond, $92, same thing as we did there. So now what we can see is that the price of the bond, $92, it's below its par value. This is what we call a discount bond, because we can see now that the coupon rate, which is 5%, it's less than the market discount rate there of 8%. And if we just think about it for a minute, let's make it simple. Let's say Riverside Retail, they just sell clothes, but now their range of clothes isn't so popular anymore. So investors are only prepared to pay $92 for this future stream of cash flows, right? So they're only prepared to pay below par for this future stream of cash flows. And if they pay $92 today and hold the thing to maturity, they're going to get a return of 8% on their investment. We're going to talk about that in a few minutes' time. But now let's pretend we've got scenario 2. Let's say the market discount rate on Riverside Retail's bonds is 4%. So let's say now Riverside Retail, their clothing range is the best and everybody's crazy about their clothes. So they're very popular in the market. So this means now that investors, the yield they require on the bond It's not as high anymore. It's only 4% now. So the required yield is going to be lower now. So let's see what happens if this is the case. So only thing we need to change in the calculator is change the 8 change the yield from the required return, change from 8 to 4. And we hit the present value. So now we can see that the price, it's above the par. So now it's a premium bond. So if it was like this, if Riverside Retail was very popular, the company was performing very well, we would expect their bonds to be trading above par, because the coupon rate now is of 5% is above the market discount rate. So if this is in scenario 2, investors are prepared to pay $102 for this expected stream of cash flows, because they perceive the risk to be a lot lower in Riverside Retail. So let us now try another scenario where they're still issuing this bond, but look at the only difference now. Now the bond is doing semi-annual payments, and most bonds work like this, right? And let's keep the market discount rate at 8%. That was scenario 1, when when the clothing range wasn't so popular. So now to work out the price of the bond per 100 of par, how many periods have we got now altogether? Well, it's a 3-year bond. There's 2 payments a year, so there's going to be 6 periods altogether. And what's the coupon going to be now? Well, it's not going to be $5 anymore, because they're paying coupons twice a year, which means they're going to pay $2.50 every 6 months. And now what is the market discount rate going to be per compounding period? It's going to be we're going to just divide the 8% there by 2. It's going to be 4%. So now we have to do 6. We have to do 6 little present value calculations. But I guess on the exam, we wouldn't do this. We would just do it on the calculator down here. But it's just good to look at this so that we understand. So let's just do this one over here. So this is going to be after 6 months. So after 6 months, let's just put in, let's just put in there 6 months there. After 6 months, the investors are going to get their first coupon back of $2.50. So we need to discount that back for the 1 period. Every 6 months is a period. So remember, we also in quants, we called that the periodic rate. Hey, we called that the interest rate per compounding period, 4%. And then after 1 year, investors are going to get back another $2.50 over there. So in 1 year, there are going to be 2 compounding periods, right? Because there's semi-annual payments. So etc., etc. This will be 1.5 years, 3 periods, 2 years, 4 periods, 2.5 years, 5 periods. So this is going to be year 3 here. Let's just put there year 3. Make a nice year 3 over there. So in 3 years, there's going to be 6 compounding periods. So this $102.50 in today's money is $81. So then we sum up there the present value of all the future cash flows. So if the bond has a market discount rate of 8%, we as investors, we prepared to pay $92 today to receive this series of future cash flows. Right, but of course, we're going to do it like this. If it is on the exam, we're going to just make now our number of periods, as we said, are going to be 6, because it's 2 periods a year for 3 years. Our coupon we've worked out is $2.50. We've discussed the interest rate per compounding period is 4. Future value that remains, the par remains. We're going to get that back at the end. There we go. So I just wanted to then, before we go on to the next slide, have a look at this quickly. Remember the other additional notes that we send you for the additions to the CF Institute readings, the practice additions to the CF Institute readings, practice problem solutions. So for these first 8 questions of the practice problems of this reading, the CF Institute, they were using let me just get rid of this thing here. They were using the time value of money formulas, right? That's what they were doing. But what I did is I solved these questions using the calculator like we've just done at the bottom of the previous slide. So I'm sure this will help you, but maybe look at the formulas as well, because it does help to also understand what's going on. So on the exam, if we think about it, in quants, they might not even ask us one time value of money question, but they can leave it for over here, and then they're going to be applying it to the fixed income section. So we just need to be aware that we can be asked time value of money here as well. Okie dokes. So let's now go on to calculating a bond's yield to maturity. So if we now know the market price of a bond, if they give us the market price of the bond, then we can calculate the yield to maturity, or they call it the market discount rate. And it is, in fact, an internal rate of return. And we're going to see why in just a minute. So we've got the same situation here with our friend Riverside Retail. They're issuing the 3-year bond. Annual coupon rate 5%. Now they've given us the market price. This is the price of the bonds in the market, 92.27. Now they want us to work out the yield to maturity or the market discount rate. So do we remember, this is now actually going back to corporate finance, that the IRR, the internal rate of return, it's the discount rate that makes the present value of the future cash flows over here, the present value of the future cash flows over here, equal to their cost, which is the bond's market price. So we then need to solve for this IRR. And remember, we have to do it through trial and error if we don't have a financial calculator. But fortunately, we just got to plug the cash flows into the calculator. So the price is now 92.27. So we as investors, that's what we would pay now, outflow. And what would we get back? 5 end of year 1, then 5 end of year 2, then 105 end of year 3. We just hit the IRR button, and there we go. Not so bad. And that if we do now plug in the 8%, you're going to see that the equation is going to balance. This is going to be the rate that makes the present value of these future cash flows here equal to the bond's market price or the bond's cost. But what we can also do is we can use the time value of money keys. So now it's like we did almost like on the previous slide, we've just got different inputs now. So we still got 3 periods because we're talking about annual coupon rate in this example. The coupon is 5, future value 100. So this is, I put that minus sign there in red because if we don't, because remember this present value amount, it's going in a different direction to the future, this future value and the payments. If we think it from the side of the investor is going to be laying out $92 over here and then getting back $5 every year for 3 years plus $100 at the end. So we can have a minus there and 2 pluses. If we'd made that a plus sign, then we would actually get an error on our calculator. Our calculator wouldn't know what to do because we're not specifying that we've got cash flows going in different directions. Okie dokes. So I think all of us, when we start doing these things, we all make the mistake of forgetting the having a minus sign if the cash flow is going in another direction. But with a bit of practice, we're going to get it right. So just before we leave the slide, I wanted to just mention something that, because once somebody sent me a question and is asking me, they've given me an example of what, remember the step up coupon bond, where the bond pays higher coupons every year. And let's say it was paying 5% coupon in year 1, then 6%, and then 7%. So the guy was sending me an email and he said to me, I can't use this payment function here because we've got different coupons every year. But so how to solve this with a calculator? And I replied to him and said, why don't we just plug in the cash flows here? You can use this method. So you can make that cash flow 1.5, then this cash flow 2 would be 6 if the second cash flow was $6, and then cash flow 3 if the third coupon was $7, and that would be 105. So sometimes we may only be able to use this method, the cash flow buttons, if the coupon varies. But if the coupon doesn't vary, then we can always use this old-fashioned way, the time value of money buttons. Good stuff. Right. So now we need to look at this yield to maturity in more detail. Why? Because it's so important. It's such an important thing in the fixed income and in the bond world. So what is it? It's the rate of return the bond rate of return on the bond that investor gets, assuming these three things. Number one, the investor must actually hold the bond to maturity to get that return of the 8% that we worked out. And then all the coupon and the principal payments, they have to be actually made by the issuer. So Riverside Retail, they can't default on any of the payments. And then the last assumption is that the investor must reinvest the coupon payments he receives at that same yield, at that 8% that we worked out on the previous slide. So let's now continue on with our example so we can learn some very important things about bonds. So if the bond price falls because Riverside Retail has become more risky, so now their clothing range is getting worse. Nobody wants to buy their clothes anymore. So we can see that the yield to maturity will increase. So let's assume that the credit risk of Riverside Retail, let's say, deteriorates, as we said, because the clothing range is bad, and now the price of the company's bonds, they fall to $80 in the market. So they were $92. That now they've fallen to $80. So now investors are only prepared to pay $80 for that expected future cash, for those expected future cash flows of the bond, not the 92 anymore. So if we now, all we need to do from the previous calculation that we did is change the present value. It was 92. Now we've got to make it 80. So now what? Now we see the yield has gone up to 13%, and it was 8%, if I'm not mistaken. Am I right? Yes, it was 8%. So now the price of the bond has fallen. It's become more risky. So now investors, they require a higher return, right, because of the extra risk. So that's a very important principle, and we're still not done with this principle. We've got more to talk about it. But just before we continue talking about that principle, we can also do the IRR calculation if we want to. And if we just now make cash flow 0.80 and not 92 anymore, you're going to get the same answer. So I just then double checked, and you can see now if we plug in 13.5% here and not 8 anymore, then the price is going to be $80 and not 92 anymore. Okay, dokes. So as we can see, and we've mentioned this already on the previous slide, now we're going to do it again in more detail, right? So if Riverside Retail becomes more risky, investors require a higher yield. So if the bond price falls, the yield, the investor demand is higher because there's more risk. So this explains an important principle, if not the most important principle of bonds that we're ever going to learn, that the price of the bond goes down, the yield goes up. So we need now a higher denominator over here to bring the price down to 80, because remember, the price fell in the market, fell down to 80. So we need now a higher denominator, high yield here to bring the price down to 80. So I just want to stop here for 1 minute and just chat about something we've mentioned in other classes, whereby we've said that the yield, or the yield to maturity on a bond, it's very different to the coupon, because we can see the yield to maturity here, this changes as the bond price changes. We can see that, but the coupon is fixed. So the coupon, it's a different story to what the yield on the bond is. And at last we've got here, because we've promised to talk about it, and now we can see exactly that. And I wanted to mention one other thing as well. Oh yes, and that is the problem with bonds is that they quoted either with price or yield. Now a share price is easy. A share price is the share price. It's only price. We don't ever work out yields on shares. But with bonds, so if Riverside Retail becomes more risky, we let their share price, let's say, would drop from $100 to $80. Same with their bonds. Their bonds will also drop from $100 to $80. But now we need to know that with bonds, if the price changes, then the yield also changes, right? Not with shares. I just wanted us to understand that. Okay, so here we go. Here's the but, and this we're going back to now our yield to maturity the three things about yield to maturity we learned on the previous slides. So, but remember, investors are only going to get this average return of 13.5% per annum if what? What do they need to do to get this? They've got to hold the bond to maturity. They've got to receive all of these payments to get the 13%. Number two, all coupon and principal payments, they must be made by Riverside Retail, so there must be no default over here by them. So let's say Riverside Retail, they get into trouble now, and they don't pay all the coupons, or they pay less than par at maturity. Then what will the investor get at the end of the day? At the end of 3 years, the investor is going to get less than 13% per annum. So just for fun, what I did is, and I just want to get my book out here because I wrote it in my book somewhere here. I worked out, let's say, for example, Riverside Retail, instead of paying back $100 at the end of the 3 years, they only pay back $80. So now what will cash flow 3 be? Cash flow 3 was only going to be 85, because they're paying back $80 of the 100. Let's say they do make the last coupon, though, that they do pay that back. If you now plug these numbers in, and instead of using 105, you use 85, you're going to get a total return that the investor got was only 6.25%. That's what I worked out. Or what you could do is here, for this future value, you could plug in 80. If you plugged in 80 there for the future value and not 100, then you're going to see that the return the investor get was also just 6.25%. Right, so I just wanted us to understand that. Good. And the third thing, you're only going to get the 13.5%, remember, if we reinvest the coupon payments we get at that same yield. We might not be able to, but it's just one. But often we don't reinvest at the same yield, but it's all we've got to work with. But if we do all bonds calculations the same manner, then it's fine. Then it's apples with apples. Okie dokes. So now, okay, this calculating the value of a zero coupon bond, I want to come back to, I'll tell you why, because while we've just done this, price down, yield up, we've gone through the whole story, let's go straight onto the relationships between bond price and bond characteristics. And this is now done, right? If the market discount rate goes up, or the yield to maturity goes up, we've seen bond price down, and it's vice versa as well. We worked the other way around. We said when the bond price went down to $80, the yield went up, which means the other way works as well. If the yield to maturity goes down, the bond price is going to go up. Right. So now another thing we need to know is that when the yield to maturity of a bond goes down, the percentage price change is greater than when yields go up. So we've got a little example here to explain that. And this is actually good news. So when yields go down, the price goes, when yields go down, the price goes up. So we get a greater amount of price increase than we do price decrease when yields go up. So let's see. So we got a 3-year bond, annual coupon rate 5%, and I put the coupon in green for a reason. We'll see at the bottom of the slide. So now when the market discount rate is 5%, you guys can just plug in the numbers there and check that the present value of the bond is 100. But now let's say market discount rate is 3%. So the bond has become less risky. So the market discount rate now only 3%. So now if we plug in 3, the only thing we need to change from above is make the discount rate 3%, not 5 anymore. With the present value now, if it's less risky, we're prepared to pay more. We're prepared to pay $105 for the expected future cash flows. So what's the amount above par? $5.66. So the yield has gone down. The price has gone up, like we saw above there. Okay, so yield down, price up. Now what happens if the market discount rate goes up to 7%? So in other words, the bond has become more risky. Investors demand a higher return, they demand a higher required return. So only thing we need to change is the 7. Of course, the bond price is going to fall now. Investors are only prepared to pay $94 for the expected future cash flows. So now, what is the amount below par? It's $5.25. So yield has gone up, the price has gone down. So now we can go back up here and see what we said is true. when the yield goes down, like over here, the percentage price change is greater. We went up $5.66 compared to when yields went up. When yields went up over here, the price went down 5.25. So the price of the bond is going up more than it is going down for the same change in yield. Okay, we changed yield to 2% down and then 2% up. And they call this the convexity effect. And we're going to be doing that in a lot more detail in the next study session. Excellent. So this is why I put the coupons here in green. So here we've got the coupon rate in green. So in the first scenario, the coupon rate was the same as the yield to maturity. Yield to maturity there is in red. So there we can see the bonds at par, right? And then what happens if the coupon rate now here, it's 5, it's greater than the yield to maturity of 3. So it's greater than the market discount rate of 3. So now it's going to be the price is above par, like we see above. It's a premium bond. And what happens then lastly, if the coupon rate, the 5%, is now below the yield to maturity of 7 there, the coupon is below the yield to maturity or market discount rate of 7. So now the bond price is below par. And of course, there it's below par, and we call that a discount bond. Excellent. We've got more relationships that we've got to know over here. And remember, relationships are very important for the exam. So let's see the next ones that we've got here. So for bonds that have got the same time to maturity. So remember, we discussed in the previous readings that, different bonds have got different maturities. We're going to have like 5-year maturity or 10 years to maturity or 15 years or whatever. So let's say we've got 2 bonds and they've both got 10 years to maturity. So now when the market discount rates or the yield to maturities, when they change by the same amount, the bond that's got the lower coupon, that's going to have a greater percentage price change than the bond that has got the higher coupon. And they call this the coupon effect. So which bond has got the lowest coupon of them all that we discussed in the previous readings? Of course, it's the zero coupon bond. So the zero coupon bond, that's going to have the greatest percentage change in price when yields change. And another way we can think about it, let's say now we work the other way around. We got a bond that's paying a high coupon. This means more of the bond value is going to be received earlier if the coupon is higher. So therefore, for a higher coupon bond, it's going to be less sensitive to changes in price when yields change. Right. So now the next relationship we're going to know is that for bonds that have got the same coupon rate. So let's say we've got 2 bonds and they've both got a 5% coupon rate, for example. So now when market discount rates or yields change by the same amount, the bond that's got the longer term bond, let's say we've got one bond that's got 10 years to maturity. So let's put a 10-year in there. And we've got another one that's got 1 year to maturity. So the bond that's got 10 years to maturity, that's going to have a greater percentage price change than the shorter term bond is going to have. When they call that the maturity effect, which makes perfect sense because the longer term bond, it's more risky. There's much more uncertainty, about the bond's cash flows 10 years from now compared to 1 year from now. So we'd expect the shorter term bond to have less sensitivity to change in yield and the longer term bonds to have more sensitivity to the changes in yield. Right. So unfortunately, there is a damn exception over here. So there can be an exception for low coupon, but not zero coupon bonds, for low coupon long-term bonds that are trading at a discount. So in this situation, what we can have, if we've got a long-term low coupon bond that's at a discount, it could actually change by a smaller amount. Let's put an S there, and that's going to be the exception. The exception is going to be that this bond trading at a discount, it's got a low coupon, could actually change by a smaller amount when yields change. But it is an exception. We don't have to go into all the detail. It's quite complex why we just got a note like that, but it's not very common that we see this. The general rule is the longer the term of the bond, the more the price is going to change when yields change. So then this maturity effect, then it always works for bonds that are at a premium. Okay, only the exceptions only for discount bonds and bonds at par. It always works for bonds at premium and at par, and it also always works for zero coupon bonds, because the exception says for not for zero coupon bonds. And just before we leave the slide, one way we can remember it for the exam, we've got an L over there and we've got an L over there. So lower coupon bonds change by more, and longer term bonds, they also change by more. Right. So that is a way we can remember it, that L's, both the L's, they change by more. Right. Now, the last relationship we need to know is this thing called the constant yield price trajectory. And this shows the change in the price of a fixed coupon bond over time if the market discount rate or the yield to maturity, if it remains constant. So we'll see now in the example how this works. So as time passes, the bond price is going to change, even if market discount rates don't change. Why? Because we know what the investor gets. They get par value at maturity, and this is called pull to par effect. So let's stick with our same example we had before, the 3-year bond, annual coupon rate 5%. We had before, 2 slides ago, I think, we had a scenario when the yield to maturity was 7. We had the discount bond. If you go back there, you'll see there the price was 94. So over here, with 3 years to go, this is the price of the bond, $94.75. Now, what happens after 1 year? There's going to be 2 years left. Eh? So now there's 2 periods left only. So N is going to be 2, number of periods 2. So the important thing now is that we're going to keep the yield to maturity constant there at 7%. That's the whole thing. That's called the constant yield price trajectory. So if we keep the yield at 7, we see now that the value is 96.38. And then after 2 years, how many years to maturity? 1, right? So after 1 year, if we keep the yield at 7, it's going to be there 98.13. So we see that's what we call there the pull to par effect. If it's a discount bond and if it's a premium bond, it's going to go the other way. So just before we leave the slide quickly, let's just talk about this. Because we're going to do this actually in the next study session when we look at the risk and return in that risk and return bonds reading. So if we sell a bond after 1 year at 96.38, then there's no capital gain or loss, because that is the constant yield price, the constant yield price trajectory, that price we're going to be using. But let's say we sold the bond here for 97 up here. If we sold the bond for 97, we got to compare it to the constant yield price trajectory of 96. So there is going to be a small capital gain over there. So very important, when we work out the capital gains in the next study session, we're going to compare the price we sell at to this price over here, the constant yield price, not what we paid for it. Very important. And that we're going to be doing then in the next study session. So it's many classes to come yet. Right. So that's the end then, except that all we wanted to cover in this online class, except for one thing. Remember, we've left out the zero coupon bond because we wanted to go straight onto the relationships. But this is nice and easy. Let's just do this quickly. We just go back here to the zero coupon bond. So it's nice and easy now. We've got to, let's try the example. Zero coupon bond, yield to maturity 6%, matures in 4 years. So what's the value of the bond per 100 of par value? Well, all we need to do now is our basic present value calculation, because there's no coupons. So remember our formula, present value over here, that's what we're trying to work out, is equal to future value over here, right? So our future value, now we're going to get $100 in it's 4 years time. So we're going to discount it at the yield to maturity of 6%. We discount it back 4 years. So this is the value today. So we as investors, what will we do if we invest in this bond? We will pay $79 today, and we're going to get $100 in 4 years time, nothing in between, because it's zero coupon bond. And then these are the calculated steps, just like a normal present value calculation that we're good at. I'm not going to worry about that. But now I just want to talk about this for a minute, because we can do the same example, but use a semi-annual basis. So why would we want to do that? Because if we do it on a semi-annual basis, then we can compare it to any bond that pays coupons semi-annually, like, because most bonds actually pay coupons semi-annually. Then we can compare apples with apples. Like, for example, US government bonds pay coupons semi-annually, which are treasury bonds, and most of them pay like this. So if it's on a semi-annual basis, it's easy. We know what to do. We now got 2 periods a year for 4 years, so we've got 8 periods, and our interest rate per compounding period, we just divide by 2. So our interest rate per compound period is going to be 3%. So there we go. There's our interest rate per compounding period there, the 3%. And we've got 8 periods altogether now, because it's 2 periods a year for 4 years. So that's 78.94. Or we can use the calculator buttons there, the time value of money buttons, if we want to. Good stuff. So then that's the end of that class. So just practice lots of examples, practice all the calculations, do all those CF practice problems that we looked at quickly earlier on. And then this will all become fine. Just apply our quant stuff and we're going to master this. And we'll see you in the next class. Hello, it's Tim here again. I hope you enjoyed the class and found it beneficial. We have some classes available for free on YouTube, but we have classes for the entire curriculum. The classes that are not on YouTube can be purchased from us. If you'd like to purchase the classes, please contact us for the pricing, and I've put our contact details over here. You can purchase all the classes or certain readings that you would like. When you purchase the classes, we provide you with the slides and our notes. I've assisted hundreds of candidates pass CFA exams, and I look forward to also helping you through the CFA program. I've put in 2 testimonials in the slide over here, and we also have a testimonials page on our website that you can review. I look forward to seeing you soon, and all the best.
Okay, that was only the first video presentations about, of course, the fixed income validations, because as I mentioned earlier, we have 3 different investment methods now. So the first one, of course, is the debt investment, wherein the equity investment or company ownership, and the hybrid investment. So the debt investment can be further broken down into subcategories, the public and non-public or private investment. So public debt investment are any investment that can be purchased or traded in open debt markets. These are such things as bonds, debentures, and credit swaps, among others. So a company will often classify public securities as held to maturity, available for sale, or held for trading. And each of these classifications has certain criteria and specific treatments under accounting standards. On the other hand, the private debt investment are any transactions that generate asset on the balance sheet and are not openly or easily traded in markets. So, as an example, in the purchasing of another entity, accounts receivable or loan receivable, which are expected to generate some from future income. The equity investment can also be categorized as public and non-public investment. So the latter is commonly known as private equity. So which is considered as a high risk, high reward investment. In fact, equity investments are generally seen as riskier than debt investment, with the advantage of potentially generating higher returns. So public equity investment are any equity-based investment that can be purchased or traded in a market. And there are often that type of investment that someone has in mind when discussing investment. And this covers such instrument as the common stock, preferred stock, stock options, and stock warrants. So private equity investment are often large-scale investment that are not within the scope of a small investor. So leveraged buyouts, mergers and acquisitions, and venture capital investment are some of the more commonly undertaken type of private equity transaction. So the hybrid investment method. So let's look at some additional investment methods. So there are investment types that mixed elements of both debt and equity. So an example of this is mezzanine debt, no, in which an investor provides a loan to a second party in exchange for equity. So another example is the convertible bond, in which an investor has purchased a bond that has a feature whereby it is exchangeable for a certain number of stock shares of the issuing company. So there are also investment types that possess neither debt nor equity in components. So an example of this type is any investment into the asset side of the balance sheet, such as the purchase of equipment or property under PP&E. So alternatively, purchasing intangible assets such as brand or patent can also be classified as an investment depending on the strategy. And finally, there is a large class of investment called derivatives, which is, as the name implies, are derived from other securities. And there are many kinds of derivatives, all of which merit an article of their own. However, example of a commonly known derivatives are futures and options, which are investment in such instruments that base their value of an underlying stock or commodity. So I just want to give you an additional input about investment banking later. I just want to play the second video of the on how we'll be able to organize actually the organizing and valuing and describing data. Okay, so I just want to share again my screen.
Onto frequency distributions. So a frequency distribution is also called a one-way table. All it is a tabular display of data that's constructed by counting the observations of a variable by distinct values or groups. So for example, if we look at the stock exchange, what we can do is we can count all the IT stocks that are on the exchange, and we can see how many IT stocks there are, or we could count and see how many financial stocks there are, how many energy stocks, etc. Or what we can do is we can tally the values of a numerical variable into a set of numerically ordered bins. And these bins are also called intervals or buckets. So we're going to do this scenario on the next slide, and then it'll become much more clear. And also, we'll go through these definitions here quickly, but they will become a lot more clear when we do our example on the next slide. But let's go through them first. So the absolute frequency, this shows us the number of observations that fall within each bin. And then the relative frequency of observations in a bin, what we do is we take the number of observations in the bin and we divide by the total number of observations. And that's going to give us the percentage of all the observations that are in each bin. And now with the cumulative absolute frequency, so cumulative means we're going to add up. So if it's cumulative absolute frequency, all we need to do is add up the absolute frequencies. These ones over here, we're going to add them up as we go from the first bin to the last bin. And then the cumulative relative frequency, this means we're going to add up which ones now? We're going to add up these ones, the relative frequencies, these ones, as we go from the first bin to the last bin. And this is going to give us the percentage of observations that are less than the upper limit. And some people call it the upper bound of each bin. So let's do the example, then all of this is going to become clear. So we've got Riverside Retail. They've had the following annual returns on their share price over this 10-year period. So we can see some years were pretty bad, like 2010, they did -8%. But then some years were good, like 2015, they did 14.8%. So here's our return bins or interval or our buckets. So we can see they're going up in increments of 5%. And now remember the absolute frequency. What this does is it shows us the number of observations in each bin. So let's just do it for one or two bins, the absolute frequency. So let's do it for the first bin from -10 to -5. So how many times was a return in this range? Well, if we look here down here, just once was there a very bad interval. And then let's do it for the next interval, which is -5 to 0%. Well, we can see over here that -4.2 is in that range there. And then this one over here. Okay, so twice the return was in this bin over here. So what you guys can do then is just go through and just double check that for the rest of the bins, you'll see that there was 4 times the return was in this range, twice the return was in that range, and once the return was in the very good range when we had that good year there in 2015. Right, so now the relative frequency, so remember the relative frequency, all we do is we take the number of observations in each bin and we divide by the total number of observations. So if we add up here, the total number of observations, we're going to get 10. So that's why we're dividing the number of observations in each bin over there. For example, for the first bin, we were there's only one observation in the first bin. We divide by the total number of observations. So we can see that 10% of the returns were in this bin. And we can see here that in this bin, the 0 to 5% bin, most 40%. Oh, this is our biggest relative frequency. So 40% of the time, the return was between 0 to 5%. And now remember cumulative absolute frequency. So cumulative means we add up. And so if it's cumulative absolute frequency, what are we going to do? We're going to add up the absolute frequency as we move from the first bin to the last bin. So we're going to be 1 there, of course, for the first bin, and then we're going to take 1 plus 2 is 3, and then 3 plus 4 is 7, etc., etc. And then the last column is the cumulative relative frequency. So this means we're going to now add up which one? We're now going to add up the relative frequency as we move from the first bin down to the last bin. So if so our first bin is 10%, and we take 10 plus 20 is 30, and then 30 plus 40 is 70, etc. And remember what we were saying on the previous slide. What does this tell us? This shows us the percentage of observations less than the upper limit of the bin. So the upper limit here of this bin, for example, is 5%. And our cumulative relative frequency is 70%. So what does it mean? It means 70% of the observations are less than 5%. Good. So now what we can do is we can go on to the contingency table. So what is this one? So this is a tabular format that displays the frequency distributions of 2 or more categorical variables simultaneously. So this is used for finding patterns between the variables. So if we have a contingency table for 2 categorical variables, we call this a two-way table. And the contingency tables, they can be constructed by listing all the levels, also called them the categories, of variables as of we're going to list all the levels or the categories of one variables as rows, and we're going to list all the levels of the other variable as columns. That's all we're going to do. So if we've got a contingency table that has got R levels of one variables in rows, so there's the R and the R together, and then we've got C levels of the other variables in columns, so there's our C and our C, then we're going to call it a R by C table. We are going to do an example in a minute. So each variable in a contingency table, it's got a finite number of levels, which can be either ordered, which is our ordinal data, or unordered, which is our nominal data. And that's what we've discussed then in the previous class. And the data, it can be displayed, the data in the cells can, there's a bigger part, the data displayed in the cells can be a frequency, which is a count, like we've looked at on the previous slide, like an absolute frequency, Or we can do a relative frequency. So remember, if it's a relative frequency, then it's going to be a percentage. And that percentage can be based on either the overall total, the row total, or the column total. So we're going to do a table now where we're going to first do the frequency or the count. And then after we've done that one, then we're going to do a relative frequency table, which is going to give us the percentages. So we're going to do both of these, and this is going to clear all of this up. So let's do our example. So here we've got a 4x3 contingency table. So remember that is our R there. So we're going to have 4 rows, and then we're going to have 3 columns. So it's R by C. So we're going to have 4 rows here, and we're going to have 3 columns there. So it's going to be a 4x3 contingency table that's summarizing the number of stocks, and then remember that is our frequency in a portfolio of 200 stocks. And we're going to summarize now using 2 variables. Our first variable is going to be the sector. So we are going to, this portfolio is invested into 4 sectors, or 4 sectors on the stock exchange. So the portfolio is in IT stocks, financials, consumer staples. So consumer staples are things like food and those basic things. So we'll talk more about those when we get to the equity section. And then materials include things like resources and mining and that type of stuff. So of course, a portfolio wouldn't just be in 4 sectors on the stock exchange. We would be more diversified. So we would have some retail stocks and some energy stocks and more sectors, but we're just keeping it simple here by limiting ourselves to 4 sectors. And then the other variable we're going to look at is the company market capitalization. So we haven't discussed this yet, but we will be in, we see this all over the place. So what a market capitalization is, or market cap for short, it's the market value of the company. It's just the value of the company. And how do we get that? We take its share price, multiply that by the number of shares in issue, and that gives us the market cap, or the value of the company. So we're going to look at 3 levels for this. We're going to have small cap stocks. So small cap stocks, we generally, and we'll use the general classification, is that the value of the company is less than $2 billion. Mid cap is between, let's call it between $2 billion and $10 billion. And then large cap, its value is over $10 billion. So here we go. So now we're doing the frequencies by our sectors here, which are our rows. We've got the 4 rows there, and market cap. The market caps are our columns. We've got the 3 columns for the market caps. So what I want to do now is instead of going to the next slide, I want to just, I've got my book in front of me. I want to leave this slide on here. And so this is our next slide, but I want to go back to this slide over here that we've just covered. And then we can go through the next slide while we rather keep this one on the screen. So these are the observations that we can make. So for example, we can see there are 40 over here. There are 40 mid-cap IT stocks, and this is the portfolio's largest subgroup in terms of frequency. So it's the largest. So the 40 is the largest one. So the largest subgroup we've got is mid-cap IT stocks. And then these data, they call these joint frequency, because we join one variable from the row, which is over here, the IT, for example, which is our sector, and then the other variable is from the column. So that is why it's called a joint frequency. So we are counting then, the number of observations that are in each subcategory, or each subgroup, we could rather call it. And then the joint frequencies, what we can do, we can add them here across the rows and the columns, and then these corresponding sums, we call them the marginal frequencies. So for example, the marginal, if they ask us, what's the marginal frequency of IT stocks, all we need to do is add across the 3 levels of market cap. So We'll add the 20 plus the 40 plus the 10 there, so we can see that there's a total of 70. There's a total of 70 IT stocks. And then if we add the joint frequencies, let's say for this one, of mid-cap stocks across our 4 sectors, then that's going to give us the marginal frequency of the mid-cap stocks. If we take 40 plus our 20 plus our 20 plus our 10, we can see that there are over here, there are 90 mid-cap stocks. So the largest marginal frequency by sector, so our sectors over here, is the IT stocks, because there's 70 of them, and they are obviously the other sectors, we've got less of those in the portfolio. And then the largest marginal frequency among market cap, we can see, is the mid-cap stocks. We've got 90 mid-cap stocks. We've only got 60 small caps and 50 large caps. Great. So that is what it looks. That is what our contingency table looks like for frequencies. What we're going to do now, so that we've covered, what we're going to do now is we're going to express the frequency rather in percentage terms. And remember from what we did a few minutes ago, if we do in percentage terms, then we're going to do it as a relative frequency by dividing the joint frequencies. So we can divide the joint frequencies by total count, which we're going to do on the next slide. Then after we've done that, then we're going to divide the joint frequencies by the marginal frequency on a row, or we can do it we can divide by the marginal frequency on a column. So let's just jump to it and we'll see it's not that bad. So here we've got now the contingency table using relative frequencies based on, we're using here total count. So remember the total count, there were 200 stocks in this portfolio. So this is now, so because it's relative frequency, we've now converted the numbers into percentages. So let's say, for example, work out this one, the mid-cap IT stocks. The mid-cap IT stocks, we saw earlier that I think how many of them were there? There were 40 of them, right? So they make up the largest proportion of the portfolio. Okay, there it is there. There were 40 of them. If we just want to double check. There we go. There were 40 of those guys there. Divide by the total of 200. So we can see that they now make up 20% of the portfolio. They make up the largest proportion of the portfolio, the mid-cap IT stocks. And then if we want to see, what about all of the IT stocks? Well, they make up 70 out of 200, which is 35% of the portfolio. So if we just go and double check there, we can see there we go. Remember, we had 70 IT stocks in total, and then we can quickly see that that makes up 35% of our portfolio. Right. So now what we're going to do, if we're still going to use relative frequencies, but now we're going to base it on marginal frequencies of market cap, and market cap is our columns. So we're going to base it on as a percentage of our columns. So let's do it then for our mid-cap stocks. So we're looking at the columns here, the small, the mid, and the large. So in this little example, we're doing for mid-cap stocks. So let's do it then for IT first. So remember the IT, there were 40 of them, and there was a total of 90 mid-cap stocks. So there we go. So it's 40 over 90. So now we're doing the relative frequency for the column. So for IT, it's going to be 40 over 90. For financials, it'll be 20 over 90. Consumer staples also 20 over 90, and materials will be 10 over 90. There we get the percentages then for that column. So let's have a look where we are now. There we go. Okay, so that's what I was saying. So the financials, they're going to make up 22% for the mid caps. The consumer staples also 22%, and the materials only 11%. So what can we then conclude? We can say that this portfolio, we can describe it as a mid-cap orientated portfolio. So if we just go back here as well, we can see quickly, there we go. It's mid-cap orientated because it's by mid-caps of 45% versus 30 and 25 for the other caps. And with the biggest weighting in IT. So we can see there, we've got 35% in IT and the other sectors are lower. Great. So what we now need to look at, the last thing we need to look at in this class is the applications of a contingency table. And the first thing we can use it for is a confusion matrix. And hopefully we're not going to get too confused by this, but only kidding, it's not so bad. So what this does, it evaluates the performance of a classification model. So we've got this little example here. We've got a model that classifies 1,000 companies into two groups, those that increase their dividend payments and those that do not increase their dividend payments. So this confusion matrix for displaying the model's results is just going to be a 2x2 table, like we'll see over here. It's 2x2 table over there. And it's going to show the frequency of actual dividend increases versus the model's predicted frequency. So we're going to compare actual dividend increases versus the model's predicted frequency of dividend increases. So we've got the predicted increases over there and with the actual increases over here. So if we look over here on the right hand side, we can see what this model is telling us. It correctly predicts 710 cases of dividend increases. Why? Because here we've got predicted increase, yes, and in actual, so the prediction was for an increase in dividend payment, and what actually happened? Yes, the dividend did actually increase. So it's correctly predicting 710 cases of dividend increases. So when we've got a yes and a yes corresponding, then the model is working. And what is it also correctly predicting? It's correctly predicting 260 cases of no dividend increases. So here, the predicted increase was for no increase. And what actually happened in the real world? Yes, there was no, in 260 cases, there was no increase in dividends. So there again, the model is working. It's correctly predicting 260 cases of no dividend increases because the prediction was an increase in dividend, and what actually happened? Beg your pardon. The prediction was for no increase in dividend, and what actually happened? There was no increase in dividend. But now, when we've got a no and a no corresponding, and that is also meaning that the model is working. So if we have a yes and a yes corresponding, or a no and a no corresponding, then the model is working. But when we have a yes or a no together, or a no and a yes, that's when the model is not working. So over here, let's have a look at this one over here. So the model, it incorrectly predicts 20 cases of dividend increases where no increases actually incurred. So that's a mistake. Why? Because the model was predicting an increase, but in the real world, the increase actually did not happen. So that is an incorrect, that the model got wrong. So there we had a yes and a no corresponding. So that was a mistake from the model. And then lastly, it also now incorrectly predicts 10 cases of no dividend increases where increases actually incurred. So that's over here. So the model is predicting that there is no dividend increase, but what actually happened in the real world? There actually was an increase in dividend. So that is also a mistake. So there we've got a no and a yes, and that is then was instance where the model was not working. But we can see the model overall looks pretty good because the correct predictions over here, these two, far outweigh these two incorrect predictions. Right, and then the last thing that we're going to need to, the other, well, not the last thing, but the other application, this is the last thing we're doing, the applications, but the other application we need to focus on is look at the potential association between two categorical variables. So in our early example that we did, we can investigate whether the distribution of stocks by sectors is independent of the levels of market cap. So if we take the IT sector, if we go back there, you can see that the small and the mid cap stocks, so the small in the IT sector was 20 and the mid caps were 40. So this means that 85% of the stocks are small and mid cap stocks in the IT sector. So it looks like the distribution of stocks in the sector, it looks like it is not independent of market cap, because the small and the mediums, they are dominating by far. So what we can do is we can perform what we call a chi-square test of independence to test for a potential association between categorical variables. Now, I don't want you to panic now, because we are going to be doing the chi-square test in a lot more detail when we get to hypothesis testing. So, and that's what I say this down over here. So we're just going to go through this quite quickly. And then once we've done hypothesis testing, maybe you can come back here and you'll see it's actually not so bad. So what this does, it involves using the marginal frequencies in the contingency table to construct a table with expected values of the observations. And then the actual values and the expected values are used to derive the chi-square test statistic. And then what we do is, once we've got this test statistic, it is then compared to a value from the chi-square distribution, and we call that value the critical value. And we're going to talk, we're talking a lot about that when we get to the hypothesis testing. And we get this critical value for a given level of significance. We often use 5%. That's our most common level of significance that we use. And then this is the bottom line, that if the test statistic, if it is greater than our chi-square distribution value, which is our critical value. So if the test statistic is greater than this critical value, then there is evidence to reject. We're going to reject the claim of independence. So if we're going to reject that there's independence, what does that mean? It means there is going to be significant association between the categorical variables. Great. So that's then the end of that class, and we'll see you guys then in the next one. Hello, it's
Okay, so again, as I mentioned earlier, I just want to share about investment banking. Investment banking is the division of bank or financial institution that serves governments, corporation, and institution by providing underwriting. So when you see underwriting, that is capital raising and mergers and acquisitions, yung M&A. So advisory services. So investment banks act as intermediaries between investor who have money to invest and corporation who require capital to grow and run their business or businesses. And this guide will cover the investment banking is and what investment bankers actually do. So what do investment banks do? There can sometimes be confusion between an investment bank and the investment banking division or the IBD of bank. So full service investment banks offer a wide range of services that includes underwriting, merger, of course, yung M&A, no, yung mergers and acquisitions, sales and trading, equally research, asset management, commercial banking, and retail banking. So the investment banking division of a bank provides only the underwriting and merger and acquisition advisory services. So the full service banks offer the following services. Number one, underwriting. So underwriting, capital raising, and underwriting groups work between investors and companies that want to raise money or go public via the IPO process. So this functions serves the primary market or the new capital. When we say mergers and acquisition or M&A, advisory rules for both buyers and sellers of businesses managing the mergers and acquisition process start to finish. On the sales and trading, no, matching up buyers and sellers of securities in the secondary market, because sales and trading groups in investment banking act as an agent for clients and also can trade the firms on capital. We have also what we call equity research. So the equity research group research or coverage of securities helps investor make investment decisions and supports trading of stocks. And of course, the asset management, no? The managing investment for a wide range of investors, including institutions and individual across a wide range of investment styles. So underwriting service and investment banking. So underwriting is the process of raising capital through selling stocks or bonds to investor, no? On behalf of corporation or other entities. Business need money to operate and grow their businesses, and the bankers help them get that money by marketing the company to investor. And there are generally three types of underwriting. Number one, firm commitment. The underwriter agrees to buy the entire issue and assume full financial responsibility for any unsold shares. We have also best efforts. The underwriter commits to selling as much of the issue as possible at the agreed upon offering price, but can return any unsold shares to the issuer without financial responsibility. And all or none. No? If the entire issue cannot be sold at the offering price, the deal is called off and the issuing company receive nothing. So once the bank has started marketing the offering, the following book building steps are taken to price and complete the detail. Okay? So prospectus with price range, institutional investor commitment at firm price, book of demand build, price is set to ensure clearing, and of course the allocations is very important. Okay? So actually, there are a lot of things to cover, especially when it comes naman sa merger and acquisitions advisory services. So the M&A advisory services is the process of helping corporations and institutions find, evaluate, and complete acquisitions of businesses. And this is a key functions in iBanking. No? Banks use an extensive networks and relationship to find opportunities and help negotiate on their clients' behalf. No? Bankers advise on both sides of merger and acquisition transactions, representing either buy side or the sell side of the deal. So what will be the process and merger and acquisitions? They started from acquisition strategy, acquisition criteria, searching for target, acquisition planning, valuing and evaluating, negotiation, due diligence, purchase and sales contract, financing, then the implementations. So how about the banking clients? Now, investment bankers advise a wide range of clients on their capital raising and merger and acquisitions needs. No, this client can be located around the world. So investment banks client include governments. So when you say government, investment banks work with governments to raise money, trade securities, and buy or sell crown corporation. When you say corporation, bankers work with both private and public companies to help them go public. So raise additional capital, grow their businesses, make acquisitions, sell businesses, units, and provide research for them and general corporate financial advice. And the institution is a bank works with institutional investor who manage other people's money to help them trade securities and provide research. They also work with private equity firms to help them acquire portfolio companies and exit those positions by either selling to a strategic buyer or via an IPO. So, how about the investment banking skills? So, the iBanking work requires a lot of financial modeling and valuation. So we therefore underwriting or merger and acquisitions activities. No? Analysis and associate at banks spend a lot of time in Excel, building financial models and using various valuation methods to advise their clients and complete ideas. So investment banking requires different skills, no? Like financial modeling, no? Because performing a wide range of financial modeling activities such as building three-statement models, discounted cash flow models, LBO models, and other types of financial model. It must be, you have skills as a financial modeling. Another, of course, is the business valuation because using a wide range of valuation methods such as comparable company analysis, precedent transaction, and DCF analysis. We have also what we call pitch books and presentation. So building pitch books and PowerPoint presentations from scratch to pitch ideas to prospective clients and win new business, check out CFI's pitch book courses. We have also transaction documents, no? Preparing documents such as confidential information memorandum, UCIM, investment teaser, term sheet, confidentiality agreement, building a data room, and much more, no? Like check out CFI's library or free transaction templates, no? Relationship management, working with existing clients to successfully close a deal and make sure clients are happy with the service being provided. And that is under, you have a skills to be a relationship manager. Okay. Another is the sales and the business development because constantly meeting with prospective clients to pitch them ideas, offer them support in their work, and provide value-added advice that will ultimately win new business. You need also to have a good skills in negotiation. Being a major factor in the negotiation tactics between buyers and sellers in a transaction and helping clients maximize value creation. Another, of course, is the careers in investment banking. Let's say, for example, right after your BSOA, you wanted to have a careers in investment banking. So getting into iBanking is very challenging. There are far more applicants than there are positions. Sometimes as high as 100 to 1. With actually, there are some additions that you need to check about on how you'll be able to be prepared, no, with the said position. Because the most common job titles, no, is from most junior to senior in iBanking, like analyst, associate, vice president, director, managing director, head, vice chair, or others special title. So, who are the main investment banks? The main banks, also known as bulge bracket banks in investment banking, like Bank of America, Merrill Lynch, no, Barclays, Capital, Citi, Credit Suisse, no, and so on and so forth. Okay? So, additional, of course, is if you wanted to consider a financial modeling, no, a financial modeling is simply a tool that built in a spreadsheet, no, software such as MS Excel to forecast a business financial performance into the future. So the forecast is typically based on the company's historical performance, assumptions about the future, and requires preparing an income statement, balance sheet, cash flow statement, and supporting schedules. So from there, more advanced types of model can build such as discounted cash flows analysis, no, leverage buyout, mergers and acquisitions, and sensitivity analysis. Okay, so I think that's it for now because we have still a lot of things to play and to discuss with this topic, but I think it's already 7:32, no? So again, thank you for attending our class.